All right, let's dive into the latest earnings from cloud computing company Nutanix. They just wrapped up their 2025 fiscal year, and the results? Well, they're a real head-scratcher for investors. We're looking at a classic beat and drop situation.
I mean, on the surface, everything looked incredible. They beat expectations on pretty much every key metric. But then, the stock drops about 5% in after-hours trading. So what gives? What spooked the market? Let's get into it and figure this out.
Okay, first up, let's talk about the numbers themselves, because honestly, they were strong. No two ways about it. So for the fourth quarter, revenue hit over $653 million. That's a 19% jump from last year. And we're not just talking about meeting expectations here. They blew past what Wall Street was projecting. And it wasn't just the top line. Profitability was looking great too. Their adjusted earnings per share, that's non-GAAP EPS, landed at 37 cents. The street was looking for 33 cents. So, bottom line, more sales and more profit than anyone saw coming. You can see it right here. It was a clean sweep. Revenue, earnings, they beat on both fronts. This is the kind of report card that usually gets you a gold star from the market, you know? And if you zoom out to the full year, the picture gets even better. The company generated a whopping $750 million in free cash flow. That's a 30% margin, which is just a fantastic sign of how healthy and efficient this business is running. Now that awesome free cash flow brings us to a really important metric in the software world, the Rule of 40. It's basically a quick health check. You just add the company's revenue growth rate and its free cash flow margin together. If that number is over 40, it's a huge green flag. It tells you the company is balancing growth and profitability perfectly. So, what did Nutanix score? A 48. I mean, that's not just passing the test, that's acing it. And this is the second year in a row they've done it. Growing this fast while churning out cash is really, really hard to do. Which, yeah, just makes that stock drop even more confusing, right? All right, so the numbers were stellar. But what about the story? Let's look at what management was saying, because they were painting a pretty rosy picture for the future. One of the biggest things they talked about was this huge customer win in Germany. They signed a multi-year deal with a company called Finanz Informatik. Now, this isn't just any company. They handle the IT for German banks that serve something like 50 million customers. A deal that big in an industry that's so heavily regulated, well, that's a massive stamp of approval for Nutanix. They also spend a lot of time talking about their partnerships. They're teaming up with the big guns, Dell, Google, NVIDIA. And this is smart. It gets their name out there, but more importantly, it makes it super easy for new customers to adopt their platform because it just works with the stuff they're already using. It's all about making the sale as smooth as possible. And I love this. The CEO, Rajiv Ramaswamy, he used this great baseball analogy. He was talking about the chance to grab customers from their rival, VMware, now that they've been bought by Broadcom. He said, "We're probably in the second innings at this point." What he's saying is this isn't some quick win. He sees this as a huge opportunity that's going to play out for years to come. So let's recap. We've got amazing results, a fantastic story for management. So where's the disconnect? Why the drop? Well, the problem isn't what they did last quarter. It's all about what they said they're going to do next. Okay, so for the full year ahead, management is projecting around 15% revenue growth. Now, 15% is still pretty good. But they just finished a year where they grew 18%. And if there's one thing the market hates, it's seeing growth slow down even a little bit. But the real kicker was the guidance for the very next quarter. The revenue number they put out there was a little lighter than what some analysts were hoping for. And on top of that, they had a small miss on something called annual recurring revenue, or ARR. That's a super important metric because it shows how much predictable subscription money is coming in. That combination was enough to send a shiver through the market. And really, this is just a classic Wall Street story, isn't it? Especially with high-growth tech stocks. You can have an A-plus quarter, just absolutely nail it, but if your guidance for the future is anything less than perfect, it can overshadow everything. And that's exactly what happened here. The cautious outlook just completely trumped all the good news. So, putting it all together, what's our take? Where do we see Nutanix going from here? Let's make the call. When you break it down, it really comes down to three key things. 1, the company is executing beautifully. They're growing and they're profitable, which is the holy grail. 2, this whole VMware situation is a golden opportunity to grab market share for years. But 3, you've got this cautious short-term guidance that's making everyone a little nervous. Taking all that into account, our reading on the stock is outperform. Look, the fundamentals are solid as a rock, and the long-term story is incredibly compelling. Yes, the slight slowdown in growth is something to watch, but we think the core strength of this business is being overlooked right now. We're cautiously bullish. The big question heading into next quarter is pretty simple. Was this guidance just management being conservative, or is it the first real sign of a slowdown? The market has already priced in the bad news. Now it's on Nutanix to go out and prove the doubters wrong. And as always, just a reminder, this is not financial advice.